sales practices. As the limited principal, one of your main jobs will be to make sure that the people underneath you are following all of the applicable securities laws, whether or not they are federal laws or FINRA or NASD rules. This section is full of all of these rules that you must know to ensure that both you and those that you supervise are in compliance with the applicable rules. The Securities Act of 1933, we've talked about this before. This is the very first securities law that we ever learn about, and it regulates new issues. It has to do with filing paperwork. So sometimes I call it the Paper Act, just to help me remember all of the things that are required under the Securities Act of 1933. So it requires that a registration statement be filed with the SEC. And it also requires that whenever you sell a new issue, you must give out a prospectus. So a prospectus is the summary of the most important information found in the registration statement. So the whole point of the Securities Act of 1933, full and fair disclosure. The SEC is never going to audit the information to make sure that it is correct. Simply will clear an issue for sale. Simply will say that the information requested has been provided. There should be no fraud in a new issue, no misrepresentations made in a new issue. So this prospectus. Now, you'll find in this section particularly that I'm going to mention a lot of rule names, whether or not it's a FINRA rule, an NASD rule, or maybe Section 10 of the Securities Act of 1933. I don't need you to sit down and memorize exactly what each one is or what each one does. More likely than not, in a test question, you're going to find that it says, under Section 10 of the Securities Act of 1933, something like that. And then it goes on to say something about what is the prospectus. The prospectus is a summary of the registration statement. It's not going to ask you, what is FINRA Rule 2111? I highly doubt that. So although I will reference a lot of rule names within this section, I'm doing that primarily to make sure that everything that's on the outline is presented in the course. I don't expect you to have to actually know exactly what each one does, unless it's fairly obvious, like the Securities Act of 1933. For sure, you want to know that's the Paper Act. So, prospectus, summary of the registration statement filed with the SEC. Once SEC registration becomes effective, any advertising or sales literature pertaining to investment companies must be accompanied or preceded by a prospectus. Customer solicitations must also be accompanied or preceded by a current prospectus. What's the latest you can give out the prospectus? If the customer's order is unsolicited, so they called you, you didn't call them, sale of a new issue, open-end mutual fund shares are always new issues, the latest you can give out a prospectus is at or prior to the confirmation of the sale. So a lot of times we talk about prospectus must be given out with a solicitation. So that is one rule, with a solicitation. But if unsolicited, if the order is unsolicited, the latest you can give out a prospectus is with the confirmation. So which one is going to be on your test, I'm never quite sure. So you just have to carefully read the question. It is true, it can be given out with the confirmation. Information that's in the prospectus must be updated as necessary, so periodically. But under the Section 10 of the Securities Act of 1933, there is a rule about the information in the prospectus. So information in a prospectus. So a lot of times, mutual fund companies will update their prospectuses, let's say January 1st. The rules say that if a prospectus is in use for more than 9 months, So let's say 1/1, let's say it was new here, and it's in use for more than 9 months, so it's still being used as of October 1st forward. It cannot contain information that is more than 16 months old. So information in the prospectus. If the prospectus is older than 9 months, which that's very common, the information in the prospectus can't be more than 16 months old. So basically, if this was when the prospectus was published, if the financial information being used as of October 1st or later was information that was prior to July 1st, so June 30th or earlier, then it would be too old to be used in the current prospectus. So probably just going to be a number question. Prospectus in use for more than 9 months cannot contain financial information more than 16 months old. Section 12 of the Securities Act of 1933 addresses civil liabilities arising in connection with prospectuses and communications. So there's this rule that says that any time you offer or sell a security through an interstate sale, so across state lines, it should not include an untrue statement of a material fact or omit a material fact. So that's common sense. Prospectuses cannot omit material facts, contain material misstatements. If it does, your client can sue you. So under Section 12, what may they sue you to recover? So civil liabilities under Section 12 of the Securities Act of 1933. So client may sue you to recover. Consideration paid for the security, so what was paid, plus interest. Generally speaking, how much the interest is varies by state, set by the state securities administrator. Less any amount of income received. Less any income received. So if the security that was sold to you in violation of the act paid you dividends, or you sold and had a gain, or maybe it was a bond and it paid interest, minus that. So this is what the person may sue you to recover. If they do not own the security anymore, they can sue you for damages. This is not eligible for what is called triple fees or treble damages. Triple damages, treble fees, sometimes we call those. Certain things are eligible for triple damages. Granted, I'm not a lawyer, so I can't make you an exhaustive list of those. But, for example, violations of the Insider Trading Act is eligible for triple damages. This is not one of those. So they can get what they paid plus interest minus any income received. Or they can sue you to recover damages if they don't own it any longer. SEC Rule 134 is the tombstone advertising rule. So a tombstone, think of a person's tombstone, it's going to have just basic general information. So the tombstone advertising rule limits the information that may be included in communications with the public made prior to the delivery of an investment company prospectus. So what can be included within this tombstone? The client has not received the prospectus yet. A general description of the fund, its investment objectives, the name of its advisory company, its most recently calculated net asset value. So that's the tombstone rule. Performance-related information may never be shown in a tombstone. Tombstones must always communicate to prospective investors that they should contact the fund in order to obtain a complete prospectus prior to investing. So it's this idea that we don't want people to make an investment decision until they have read a prospectus, because that's the information that they should read. Granted, we know they don't read them, but that they should read them. We're trying to get them to read them, encourage them. SEC Rule 482 is known as the omitting prospectus rule. It omits some of the information contained in a full prospectus. So the omitting prospectus rule allows investment companies to send prospective investors a summary prospectus that summarizes information found in the full prospectus prior to giving them the full prospectus. A summary prospectus may contain performance information. It may not contain an application to invest because it doesn't have enough information. It doesn't include everything that the full prospectus will include. SEC Rule 498 deals with what is called a profile or standardized summary. So an investment company may provide a profile of the key information contained in the fund's prospectus along with an application to invest. So summary prospectus cannot contain an application to invest, but a profile may contain an application to invest. Potential investors who receive a fund's profile have the option of purchasing shares or requesting a full prospectus. If they buy shares based upon the profile, the fund must send them a full prospectus along with their confirmation. So we said confirmation can include the prospectus if it's an unsolicited transaction. It's also true if the client was given a profile, they can make an application, they can make an investment based upon the profile. When do you send out the full prospectus? Same as the unsolicited transaction with the confirmation. SEC Rule 135A is the generic advertising rule. It defines the type of communications that can be used without a prospectus, including those that refer only in general terms to securities as an investment, but do not refer to any specific securities. Such communications may explain the characteristics of the different types of funds, but cannot refer to the desirability of any one fund specifically. So a lot of times you'll see mutual fund company A, it's a generic advertisement. It can only refer in general terms, but cannot refer to any specific security. SEC Rule 156 defines investment company sales literature broadly as any communication in writing or by radio or television that any person uses to offer to sell investment company securities. This rule makes it unlawful to use sales literature that is misleading or contains any untrue statement of a material fact. So thankfully, quite a few questions in this section are common sense. We know that. Communications with the public cannot contain promises of specific results and cannot guarantee specific results. No profit guarantee, no loss guarantee. That's found under SEC Rule 156. Factors affecting whether sales literature might be considered to be misleading include, but are not limited to, the following. So the use of material that is current, complete, and accurate. You would want that within your sales literature. The context in which statements are made. The failure to explain, qualify, or limit statements, general economic considerations, representations about past or future investment performance, portrayal of past income, gains, or growth of assets, statements about possible benefits connected with or resulting from the services to be provided, claims about management skills or techniques, comparison to other investment vehicles or indices, statements involving the characteristics or attributes of an investment company. So just use your best common sense judgment as far as does it seem to be a misleading communication. The Investment Company Act of 1940. This act prohibits false statements of material fact The omission of material facts, it also prohibits making exaggerated or unsupported claims. That's also common sense. You guys know that. FINRA and NASD conduct rules. So FINRA Conduct Rule 2010 states that a member firm in the conduct of its business shall observe high standards of commercial honor and just and equitable principles of trade. So this idea that we want to be good people, we want to raise the industry standard. So that's actually one of FINRA's conduct rules. Conduct Rule 2020 states that no member firm shall effect any transaction in or induce the purchase or sale of any security by any means of any manipulative, deceptive, or other fraudulent device or contrivance. Once again, common sense. FINRA has communication rules. So FINRA has recently made some pretty major changes to the communication rules. They've changed the different categories of communications. So this is relatively new. If you've heard something else described a different way, that's probably the old rule. You want to always know the newest rules to pass your test. So FINRA Rule 2210, we're going to do 2212 through 2216. So there's a lot of rules included within these FINRA communication rules. So we need to know the communication categories. There are three categories of communications. We're going to have institutional communications, we're going to have retail communications, and we're going to have correspondence. So these are the three categories under FINRA's newest communication rule. Institutional communications include written, including electronic, communications that are distributed or made available only to institutional investors. Under this FINRA rule, institutional investors shall mean a bank, savings and loan association, insurance company, or registered investment company. It also includes an investment advisor, whether or not they're registered with the state or the SEC. It includes any other entity with total assets of at least $50 million. It includes a governmental entity and an employee benefit plan that has at least 100 participants. So we have to know these three categories, not only because that will be a question, but there's going to be different rules as far as principal supervision of the different categories of communications. So it's going to be really important to feel comfortable with what's institutional, what's a retail, what's correspondence. Retail communication includes any written, including electronic communication, that is distributed or made available to more than 25 retail investors within any 30 calendar day period. So retail communication, more than 25, made available to more than 25 retail investors in any 30-day calendar period. Notice we don't care if it's a current or prospective client. There is absolutely no distinction under this new communication rule. It includes existing as well as prospective clients. So a retail investor includes any person other than an institutional investor, regardless of whether or not they currently have an account with the firm. It doesn't matter. It used to. It does not matter anymore. So we only care about the new rule. A correspondence includes any written, including electronic, communication that is distributed or made available to 25 or fewer retail investors within any 30 calendar day period. So correspondence, 25 or fewer. So maybe this is something you jot down on your scratch paper once you log into the time of your test. Institutional client, that one's obvious. But this idea of a retail communication, it's more than 25 retail investors. Correspondence, 25 or less in 30 calendar days. Institutional communications does not include a firm's internal communications. Of course, firms still have to supervise their internal communications, including those that train or educate registered representatives. So if it's training for the people that work at the firm, then it's considered to be an internal communication, not an institutional communication. If it was training material that the firm put together to train registered reps at a different firm, then it would be considered institutional communication. So there is that slight difference. If it's training material for the people at their firm, then it's an internal communication. But if it's training material for a different firm, then it is institutional communication. If it is used within the firm training materials, a firm's supervisory policies and procedures regarding internal training and educational materials must be reasonably designed to ensure that such materials are fair, accurate, and balanced. Sales scripts. So if a sales script is intended for use with retail customers, I will want you to assume a sales script. We're going to be out there making phone calls usually. They are considered to be retail communications, not internal communications. Remember, retail communications, written, including electronic, communication distributed or made available to more than 25. So generally speaking, sales scripts fall under retail communications. FINRA Rule 2210 requires an appropriately qualified registered principal, that's you, of the member firm to approve each retail communication before the earlier of its use or its filing with FINRA's Advertising Regulation Department. So this is what we call the principal pre-approval rule. So generally speaking, of course it's never always, but generally speaking, retail communications must be approved by a principal. So that's you, by a principal, either before use or before it's filed with FINRA's Advertising Regulation Department. And we'll talk about when is that going to happen. That's coming up here soon. So that's kind of the basic overall general rule. Always exceptions, of course. So FINRA Rule 2210 provides an exception from this principal pre-approval rule if, at the time the firm intends to publish or distribute the retail communication, another firm has already filed it with FINRA and has received a letter from FINRA stating that it appears to be consistent with applicable standards, and the firm using the communication in reliance of this exception have not materially altered it and will not use it in a matter that is inconsistent with the conditions of the Advertising Regulation Department's letter. So if the retail communication, another firm already uses it and already has a letter from FINRA, it's been filed with FINRA, and it's basically going to be used in the same manner, then it does not need to be approved prior to use by a principal. FINRA Rule 2210 also provides an exception from the principal pre-approval requirements for 3 additional categories of retail communications, provided that the firm supervises and reviews the communications in the same manner that's going to be required for a correspondence. So let's talk about these. So far, we're going to do three exceptions. 3 additional exceptions to a retail communication needing principal pre-approval. The first one that we already talked about was if the retail communication was already filed by another firm with FINRA, and you have the letter from the FINRA advertising department. So these 3 additional categories of retail communications that are exempt from the principal pre-approval rule include any retail communication that is accepted from the definition of research report unless the communication makes any financial recommendation or investment recommendation. So if it makes an investment recommendation, makes a financial recommendation, it is not going to be exempt from principal pre-approval. So any retail communication that is accepted from the definition of research report. Any retail communication So that's the first category. Any retail communication that is posted on an online interactive electronic forum. So posted on an online interactive forum. So these things must be supervised like under the same rules as a correspondence, which we're getting to. Any retail communication that does not make any financial or investment recommendation or otherwise promote a product or service of the firm. This would include communications such as those that alert an investor to their quarterly statement being available, or the date that a security in the investor's portfolio is expected to pay a dividend. So, retail communication that does not make a recommendation. So this idea that quarterly statements are available is made available to more than 25 retail customers in a 30-day calendar period for sure, but is not subject to the principal pre-approval rule. So NASD Rule 2711 defines research report. So we need to talk a little bit more here to understand this rule. So research report means any written, including electronic communication, that includes an analysis of equity securities of individual companies or industries, and that provides information reasonably sufficient upon which to base an investment decision. So that's the definition of what is a research report. What's accepted from the definition of research report. So in order to understand this one, the fact that any retail communication that is accepted from the definition of research report is not subject to the principal pre-approval rule, we need to know what the heck is that talking about. So communications that are limited to the following. So these would not be considered research reports. Communications discussing broad-based indices, commentaries on economic, political, or market conditions, technical analysis concerning the demand and supply for a sector, index, or industry based on trading volume and price, statistical summaries of multiple companies' financial data, including listings of current ratings, recommendations regarding increasing or decreasing holdings in particular industries or sectors, notices of rating or price target changes, provided that the member simultaneously directs the reader of the notice to the most recent research report on the subject company that includes all current applicable disclosures required by this research report rule, and that such research report does not contain materially misleading disclosure, including disclosures that are outdated or no longer applicable. Okay, so for example, a communication that discusses broad-based indices is not a research report. So it's just discussing how these indices are doing, what they cover. It is included here and within the definition of a retail communication, exempted from the definition of research report, exempted or accepted, they'll say it either way, must be supervised like a correspondence. So this exception from the principal pre-approval rule.